I think that it's fair to say that the market is bifurcating itself, and that means that there are groups of properties that are performing quite well, actually, and others that are performing less well. Those properties that are newly constructed, that have been reinvested in by their ownership, and that are well located are generally doing pretty well. And as evidence of that, if you look at the vacancy rate in the Park Avenue submarket of Manhattan, it's less than 10%, which is quite tight by historical standards. You're seeing landlords there with the ability to push rental rates, to reduce concessions like free rent, like capital that's associated with new leasing. And so therefore, net effective rents are actually increasing in that submarket. In some of the weaker submarkets and some of the older buildings, landlords have had more trouble attracting tenants. But for those businesses that are generating revenue, that have clients that need to come visit them, that want to attract talent, being in a great building in Manhattan is a really good bet for them, and you're seeing strength in that segment of the market.
So we've had some property people in here who've talked about those older buildings, and over the last few years, they spent a lot of money retrofitting them and updating them to make them more appealing. Are we seeing a lot of that still? And like, what's the cost profile for that? Like, is it pay off? Like, how does that work?
So I think it's also a little bit location dependent. You're certainly seeing some buildings spend money that would be classified as older or maybe less well amenitized, just not a newer building. But if they're in a great location, they can actually do quite well. And I would point to the Grand Central submarket as evidence of that. A lot of people who commute in the city are really looking for a one-seat commute, meaning they get off of Metro North or they get off of Long Island Railroad, they walk to their office. And so those buildings, despite the fact that they're somewhat older in that submarket, are leasing quite well. And a lot of the landlords that own in that district are amenitizing their buildings to great effect. The cost of construction have gone up radically over the last, call it 5 years, and that does definitely have an effect. It tends to favor the landlords that are better capitalized. But for those that can do it, it really does benefit their leasing velocity.
How about, like, I'm going to reference this once again. I always do when having commercial real estate discussions in New York. Bloomberg News put out a piece maybe 18 months ago, and just focusing on 3rd Avenue between Grand Central and here. We're at 58, 59th Street. You can't give that stuff away. Or talk to us about that market. I'm thinking like the Lipstick Building. When I see one of those buildings trade, is it going to be at a 30% discount, 40, 50, 60% discount? Talk to us about that kind of market, because those are more, I guess, B properties as I understand it.
Well, so there actually has been some activity on 3rd Avenue. Memorial Sloan Kettering, I believe, took some space in the Lipstick Building. One of the office buildings that is on 3rd Avenue was recently announced to be a conversion to residential. So folks are getting creative with that space. For us, in our submarkets, we're focused on attracting large corporate tenants and investing the capital that's required to attract and retain them. But I think that 3rd Avenue has hope.
So let's just game this out for a second. So swaps market's pricing in 3 Fed rate cuts now for September, right? I mean, excuse me, for the rest of the year, starting in September. Let's say that happens. What's the trickle down to the commercial real estate market in the short term?
So the transaction volume, acquisitions, dispositions has been somewhat muted. Not so much as a result of where treasuries are trading, I think, but how quickly they went from practically zero to where they are today. Any relief on the 10-year, I think, would tend to support higher transaction volumes. In our space, which is, again, the sort of higher end of the market, there's been very, very little transactions because, in general, landlords are not distressed and are not willing to sell at depressed prices. So I think it would tend to support a higher transaction volume going forward.
You guys, BXP, well-capitalized, well-experienced owner of real estate. Are you buying in New York City today?
At the moment, we don't have active acquisitions, but we're constantly looking for new opportunities. The real gating issue for us is quality. So if we cannot find something that is at least equal to the quality of what we already own, we are not buyers. And the fact of the matter is there's relatively little available in the market for purchase that is consistent with our quality. That having been said, we do have a couple of development sites in New York City. The most active of which will be 343 Madison this year. It is
Where's that?
is between 44th and 45th on Madison, and
Central.
we will begin constructing the east side access to the Long Island Railroad in Grand Central between now and the end of the year. So folks will actually see cranes and construction on the site.
Cool.
So I live in Brooklyn. What about in Brooklyn?
All the cool kids.
All the cool kids. No, but they're like retrofitted, like that sugar factory. Not you guys, but sugar factory was retrofitted. Like they're
Domino.
There we go, Domino's. Well, is Brooklyn becoming a place where commercial real estate can truly thrive?
So I would say that the demand for Brooklyn right now is a local demand. People that need to be in Brooklyn for a reason. Their manufacturers are located there, their talent base is located there. Those tend to be the companies that are expanding in Brooklyn. We own a building called Dock 72 in the Brooklyn Navy Yard, and we've had success in that building with leasing to Huge, which is a marketing company that was formerly based in Dumbo, has moved to the Navy Yard. The Pratt Institute and other large sort of Brooklyn-based institutions. I would say that Dock 72 has attracted the majority of the large tenants that are active in the Brooklyn market now, but no question, it's sort of a local demand market at the moment.